you only are going to be highly successful if you are learning every day or every week and you are open to learning. And so when you are around, people of your seniority or greater, and you're asking, what would my young self be? It would be people of much more seniority. It doesn't matter for short term how
we're talking about knowledge and ability, not just like I'm older.
No, totally. They have experience. They've done it well. And if you have to be a real junior person for a while, so be it. But if it's at a really good shop, right, and also you're working with people that give you some visibility, give you some transparency into their investment process and how they're doing it, and are willing to mentor and teach you, it's invaluable.
Hey everyone, welcome back to the Ignite podcast. Today, we're thrilled to have Terry Purcell, a seasoned alt investment expert and co-chief investment officer at the Longwell Family Office. He has a rich career spanning hedge funds, private equity, institutional asset management. He's also been recognized as a hedge fund rising star. Would love to learn about that. Terry, welcome to the program.
Thank you. Appreciate you having me, Brian.
Yeah, it's great to see you again. Terry and I saw each other last week in New York. It was my first time back in 5 years, so it was great to see some people in person. So it's good to see you through the camera this time.
Yeah, likewise. And, I wanted to accept this one because I don't think I'm your typical guest. I'm with a lot of founders and techies, so I'm a little different. So we ought to be able to have a fun conversation.
Yeah, I figured at some point I should probably learn how people make decisions on how to invest in VCs because I am one of those. But I originally started the podcast to interview founders, help them get free publicity, PR. We have tens of thousands of followers on social media. I think the aha moment for me is I went on somebody's podcast. I was like, wait, I should do this. I think at the time I had 100 portfolio. We have 160 now. And I was like, I should do this for my founders. And then that was also my VCs. And now it's also my LPs and would-be LPs. So thanks for being, you're, I think only the second to come on the show that's purely like a family office LP. So this will be kind of thanks for being the guinea pig. So I'd love to, learn about the story of how you got started in finance and eventually what drew you into alts. When I say alts, everyone, I mean alternative investments. So that's a financial asset class that's not traditional public equities.
I've been a career investor. I've been in the investment management industry my whole life. And so I was fortunate enough that right out of college, I was accepted into Payne Weber's rotational training program. They only took 5 people a year that were graduating college and let you rotate around to the various parts of their business. And it so happens that the second one I chose, my second rotation, only about 6 months in, was at their investment management subsidiary. It's a company called Mitchell Hutchins that was around for a very long time. And I pretty quickly realized that I wanted to stay there, that I wanted to do this instead of kind of rotating and seeing other areas of the business, whether it be operations or finance or investment banking, that you could do them all. But I really wanted to become a money manager and be an analyst and then a PM. It so happens that, at that time, Wall Street was in a headcount cutting mode. So you step in and you make the best. I was able to really kind of get hands-on experience, get thrown into the fire right away, start being an analyst and moving through the ranks. So that's how I got started. Later, while I was at that company, Mitchell Hutchins, I was asked to become the co-portfolio manager of an established hedge fund inside the firm that had actually existed for a couple decades. It was founded in 1982. Away we went. I basically had a focus on alternative investments, since not only in the hedge fund space, but I guess as we'll talk about,
wow. So you came right out of the gate, right into alternatives through the Payne Weber rotational program. So what was that? What did that look like back then? What were alts back then, and how has that shifted over time?
The industry was certainly smaller. You didn't hear as much about the real asset space as you do today. Strategies like investing in infrastructure and energy. Hedge funds were around, but it was certainly a nascent industry, much less regulated than it is today. Private equity obviously existed as well, but was already starting to get dominated by the large managers in the space, many of whom are still the large managers in the space, whether it be Blackstone, KKR, Carlyle, Apollo. So it was already in place and it was experiencing rapid growth. Probably talk about later. Areas of it had a pretty big sea change when the '08 crisis hit a few years later, but it was kind of very early innings of becoming the place to be, meaning the alternative investment side.
So you've worked across, these, you might call them sub-alt classes, hedge funds, private equity, real estate assets, venture capital. What are some key differences in managing these asset classes?
You have to approach each one differently. They are very different. So real assets, you look at infrastructure investments and other very long-lived investment processes. They are income-oriented strategies, so they make sense for certain types of investors and do not for others. Like I mentioned, they're very long-lived. You're often invested for, up to 15 years, but they're also low risk. And so they make sense for investors that are looking for, to not shoot the lights out, but are looking for consistent returns, consistent income. And obviously in the real asset space, like in areas like infrastructure, it's also very possible to have a positive societal and, an impact and economic impact. Hedge funds are different. Hedge funds are, flexible investment strategies that you would hope over a cycle beat the public markets, meaning, stocks and bonds, but with a lot less correlation day to day to those markets, and also ideally low volatility relative to public markets. There's a variety of strategies in the hedge fund industry, but it's not the kind of thing that you want to do lightly. A hedge fund returns vary greatly. And so manager selection is just preeminent in this asset class. If you're not with the right managers, you're really not going to have good returns at all.
It's not like, I go execute a strategy and there's an expected return. It's kind of like the manager is the expected return.
I agree. I mean, it's people based. I'd call it an absolute return strategy, meaning, even if you said to me, perfect foresight, that next year is a down year in the public markets, you would be looking to generate a positive return from your hedge fund portfolio. And so, I just think that it's an incredibly useful tool in a diversified portfolio. But I think you have to have experience. You have to know how to select managers. If you don't, I don't think it's something an investment group should be doing on their own. Private equity lifts over a cycle, you'd expect highest returns here. You know the area well, both the buyout space and the VC space.
Well, what's interesting is like venture capital is a sub asset class of private equity because, when alternative asset managers like yourself would say private equity, you mean private equity in VC. But VC is kind of secondary and smaller.
I would consider private equity to include buyouts, growth equity strategies, and venture capital. And they are long-lived, but again, you would expect it to be the highest return in your alternative portfolio. You're going to demand high returns for that illiquidity.
Right.
Again, manager selection is paramount. That the spread between top performing and bottom performing managers is massive. So again, it's something you really need to have experience in on the manager selection.
When you worked for the Connecticut Retirement Plan and Trust, how did that shape your investment strategy? Because that's a little different from what you do now at a family office.
Sure, a great deal. Clearly, when you run a pension fund, you have a long-term focus. You don't sit around thinking about decisions that might make sense for the next 3 to 6 months. You're talking 10 years to 30 years. So really, one, sharpened kind of the focus on long-term. Two, gave me my best exposure to what I'd call the endowment model, or the pension investment model. Pretty briefly, is a model that is diversified across asset classes but has a significant exposure to alternative investments, including all these areas, including yours that we're talking about. So got to see a lot of that and really develop expertise in that. And you're investing in a fishbowl compared to anything else, compared to the seats you and I are in today, or most seats. So it really makes you sharpen your focus on every individual decision. And, that's a real benefit too.
So switching gears to the family office, what's the investment philosophy there? Is that a single family office, multifamily office? And how do you guys balance traditional and alts?
Sure. Longwell is a multifamily office. It started just a little over 3 years ago as a single family office. We now have, a small handful of families. We've onboarded a bunch in the last 3 years. It's growing fairly rapidly, and we think it, will continue. So we're doing quite well. Traditional and alt. Traditional investments and alternative investments, I would say, are both very, very important in a portfolio. Every investor that comes in has a different portfolio that they onboard. Some might be heavy into traditional investments, meaning stocks and bonds, liquid stocks and bonds, and some might have a lot in the alternatives world. Each one is very important. The kind of the differentiators we have, I think, are that we customize every investor, every family's portfolio. We call it bespoke investing. And that means you sit down when you're at the front end of the client relationship, you establish what the objectives are, what the suitability that you're going to use to invest their assets, their horizon, their tolerance for risk, their liquidity needs maybe coming up, later in life and are more interested in income, younger, more interested in, growth of your riskier investments like VC, things like that. So each one is different, and no two of our portfolios look really alike at all. And definitely every single one at this point does have both traditional and alternative investments in it. So I would say we're moving family portfolios to this endowment or pension model, even though we're in the ultra high net worth space on the retail side.
Yeah. Well, I'd love to dig into that point that you made right there, this endowment model. What do you mean by that? And what is that transition happening with wealth strategies and family offices?
Well, it's the endowment model to me, which has been used by many endowments now also and pension funds very successfully. The most kind of notable endowment that did it early on was Yale, and many have copied. But really what it boils down to is there's a significant allocation to alternative investments. So, on a day-to-day basis, less of the portfolio is being marked or showing any type of volatility because only a certain percentage of the assets are in listed stocks and bonds. So they're in all these areas of alternatives that we've been talking about. But what these alternatives do, assuming you do it well, and can outperform those public markets over a cycle, is obviously add to returns, but then also diversify the portfolio, reduce the overall volatility of the portfolio. People like to say that diversification is the only real free lunch in investing. I think it's true. And then in tough years, like we saw, in 2022, 2018, and they do come every few years, the downside protection really shines. So you'll see those portfolios typically, when well constructed, substantially beat the indexes that are suffering.
Yeah, I love that. So, and I agree. I look at, as I make investment decisions around Team Ignite at the fund level, I think diversification is key as well. And I love leaning into that as a finance mind. And I was talking on the last podcast with another family office practitioner about that, how important that is. How do you guys think about diversifying across all these alternative assets that you could be potentially investing in and the time horizons? And let's just take venture capital, right? Because that's what I'm most interested in. If you're looking at some percentage of the assets of a family, of a single family, how do you think about diversifying within a venture capital asset class?
Sure. It's definitely a component of what we do. We have, just to step back a bit, we to date have really not focused on investing in commingled private equity funds, whether it be buyout or venture capital. But basically, by virtue of us being, in the industry a lot longer than we'd like to admit, we have pretty good personal networks and get shown a lot of direct company, investments, early stage or, later stage, but, pre-IPO type companies. Every client, like I meant, is different. When you run a multifamily office, just no two families are going to have the same approach. So some families love having, a pretty diversified private equity component to their portfolio. We have a client that loves to do specifically early stage investing in the life sciences area. And then we have clients that like to stay liquid, right? They look at periods like we've just had for the last 2 years where the S&P 500 has gone up 25% each. And they might say, why do I need to go over there and diversify? So again, it's customized for us with every client. Each one has really a different appetite for it, but we spend a lot of time talking to them about it, having them, if they're new to it, understand kind of the time horizons involved, the risk parameters, the return expectations we have, things like that.
So, and as you kind of look at the alternatives, the GP, the manager in this case, is of paramount importance. Discuss, your approach to manager selection, how you identify these alpha generating managers.
Great question. I'll try to be brief. I think I'm fortunate in that I was a direct investor and I sat in a seat like these managers have, a hedge fund manager. And so I kind of understand the ups and downs, the challenges of running a fund, particularly an emerging fund, and also having to run a business at the same time. So I think that, I am able to ask good questions. And it is fundamental for us. We are researching these managers on a fundamental basis. And like you said, people are of paramount importance. So, the manager really will, the ideal manager, which, may be just a couple that you invest with out of 100 you look at, right, will check a lot of boxes, for lack of a better term. They will basically be someone who's executed the strategy that they want you to invest in for a long time. They might have a young firm, or they might have a firm that's very established, but either way, you have a track record from them that you know what they did, how they did in the past, and what they're going to be doing in the future. You also have, hopefully really good confidence into what you see in terms of the business they're building. So the infrastructure they're putting in place, the people they're putting around them. Next, they are very invested themselves in the portfolio. A typical manager that we invest with, whether it be any asset class in alternatives, would have a high percentage of their net worth, of their liquid net worth in the portfolio. So that really kind of aligns interests with our clients that we're investing on behalf of.
What's a typical percentage you like to see of the net worth? I heard this from the last LP as well.
We've seen many that are, 80 to 90%.
Wow.
And so,
they have almost their entire future riding on this fund.
Yes.
Or series of funds.
Yeah. We just wouldn't invest with somebody that's not walking the walk, right?
I love that.
It's just that simple. I actually had a manager last year whose strategy was having a tough time for about 2 years. Just the market environment wasn't conducive for it, and he felt it was getting better and better. And he told me, I have, I think, 92% of my liquid net worth in the fund, and I'm going up to close to 100 at year end. That's how I feel about the opportunity set. Wow. And he was right. He's having a huge year. So, yes, they have a significant part of their liquid net worth.
Yeah,
Yes.
So you're looking at liquid assets here. Like, okay, you can put your hands on some stuff in your Fidelity account. You have, some cash, securities, that kind of liquid. Like, you're not looking at their real estate holdings, the stuff they can't really get to unless they sell it.
Correct.
Okay.
Basically, You're just saying that that they're not off with a significant portion of their investment portfolio, in their personal account, doing some other strategy. Right. They're focused like a laser every day on the investment strategy they're running at the firm that, you're hopeful they're making money for your clients in.
Because I've always heard 1 or 2% is enough. I think if I looked at my liquid assets, I think the 1 or 2% is enough, because I'm basically 3 funds in here. And I don't have a lot of liquid assets. It's all just paper assets on all these funds and these 160 startups we've done over the years now. But yeah, I would say if I was sitting on millions and millions in a Fidelity account, and I only had 50K or 100K in the fund, you'd be like, what's going on?
Right. In the hedge fund world, that's particularly where you'd see the very high percentage of liquid net worth, because hedge fund strategies are typically liquid. So they're not locking their entire life, down for 10 or 15 years. If you talk about the PE side, whether it's VC or buyout, yeah, I think that, right away, one of the questions you ask as a potential investor, as an allocator, is what's the GP commit? So that means what percentage of the assets that you're looking to close with, this fund size, is internal money from the top investors. And in my experience, I've seen 5 to 10% in a lot of cases, depending on the fund size. So you look at really 2 things. Obviously, that percentage is going to vary by what the total fund size is. But you really just kind of look at 2 things. One is the total dollars, and then what percentage of the fund's total capital does the general partner's commitment represent?
Yeah. Yeah, I think as a GP, from my perspective, that I have to think about is, these things take, 10 years, right? Or more. Right. And you don't start actually seeing returns of principal for, 3, 4, 5, 6 years. And then, you're probably sitting in year 10 at, if you're doing a good job, 4 or 5x DPI in one of these early stage venture funds. You have to be careful not to commit too much, because then, then you hit a cash flow crunch. But I think in the future, if I was on my 3rd or 4th big fund, I think I would up my percentage. I'll be thinking about that. That's good advice.
Particularly in the PE side. And we could have a whole another conversation about that another time in terms of all the trends that have happened with respect to the GPs borrowing. It's become, more than a cottage industry at this point, borrowing to fund their commitment for the new fund being raised, because, like you just said, they haven't fully been monetized from their past fund.
Right. So they got to go to a bank and say, hey, I got all this carry coming, and here's, go underwrite this. Right. And tell us about that.
Well, more likely the shadow banks. A lot of the large asset managers now have, a business of lending to general partners, and they can understand the business and the parameters of the, quote unquote loan very easily. So it kind of facilitates the ability to demonstrate your commitment to the fund you're raising right now. even though you haven't gotten all of your cash back from your current fund. So however it's done, you want to see that commitment, because to us that's just alignment of interest, right? They have a ton of skin in the game, and their fortunes rise and fall directly alongside our clients that we're investing on.
Yeah, that makes sense. Do you have any sort of percentage of fund requirements, minimums, or maximums that you look at when you're looking in the private equity space?
In terms of fund sizes?
Well, fund size would be one, check size would be another, and percentage of fund.
No, like I said, we're doing mostly direct company investments. So they vary. They typically, the investments I would say we're looking at, the company is typically raising, say, $5 million, something like that, 3 to 10, or, might be their second or third round of raise. Many of these, just to be clear, are outside of your sphere in tech. A lot of these are not tech companies. They are more industrial, consumer-based companies, like I said, life sciences as well. So it varies, but again, you're asking the key people at the firm whether they have what percentage of their net worth they have in there. It really is just kind of a common theme across the alternative space. And on the commingled side, we would typically, to the extent we really start doing more on commingled funds in the future, we would typically look at funds that are a couple $100 million and up. We wouldn't really be looking too much at $50 million funds or something like that, unless it was really idiosyncratically was a very attractive opportunity to us. So you would typically look at funds that are a little bigger, and therefore you'd see probably a good roster of institutional investors that have decent check sizes in there. Yeah. And, that checks a box for you because, they're doing their research alongside, particularly if they were invested in a prior fund vintage with that manager and they're re-upping. Re-upping is always meaning reinvesting in the new fund. That's always a key metric to be looking at. So a lot goes into it. We don't have any hard and fast rules, whether, it be on the direct company investment side or kind of on commingled funds.
Yeah. And so when you say commingled funds, you really mean like limited partnerships. So you're investing alongside some other LPs in a partnership. And that's a very typical venture capital private equity model. Versus the other side, which is, it sounds like you guys are doing a lot of direct investments where you're writing your own $3 to $5, $10 million checks directly into companies mid to late stage rounds.
Yeah, or smaller. They might only be raising 10 million in total, right? So they may end up raising that from a group of family offices or, a private wealth management platform, private banks, things like that, or even institutional investors, depending on the size of the deal. But yes, that's typically how it works. What's interesting about this space is that in the last few years, and I think probably most of the viewers will know this, the private equity industry broadly has been doing a fairly poor job of returning capital to investors. Maybe not quite as much on your side, Brian, and VC, but in the buyout space, there's been a lot of, there's just been a lack of exits, right? Of monetizations and getting the money back to the investors, the LPs.
Well, and is that because the buyout private equity funds are kind of like 5-year targets, is my understanding. And so if they started deploying capital back in 2020, 21, the M&A and IPO window has been sort of closed recently. Exactly. And so they're kind of hitting up against this 4 or 5 years, 6 years, and they're kind of like, in their fund model, they should be in DPI right now and returning, and they're not.
Agreed. You would typically see a 3 to 5 year investment period and then a harvest period for the rest of the fund life. It's been a very difficult time for PE broadly. It'll change, but like you mentioned, the M&A window has been closed, and it closed after a period of just massive asset raise.
Yeah.
Just so everybody says dry powder. The dry powder has been really significant. So, that's kind of an overhang. I think there's some nascent signs right now of M&A picking up, and a lot of people think that'll continue into 2025. But definitely, it's been very, 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 very slow now for probably 3 years. But what that does is slow new investment down by those general partners, right? They might raise their next fund a little later than they would otherwise, or they might just be slow to deploy. So the kind of direct companies we're talking about that are looking to just say raise 15 million, or where many of whom might have been candidates, to be bought by these private equity funds, are the ones out talking to communities like ours, the large family offices, the private banks and wealth platforms, to raise their capital that way.
That's really interesting. So what other kind of major trends are you guys paying attention to and advising your clients on? And as we record here, we're late 2024. Trump's got elected. I think the market's ripping right now. We're kind of going into 2025. What kind of things are you guys looking at over the next 12 months?
Well, I mean, it's fairly low risk prediction, but historically, after 2 years of very large public stock market gains, you could expect that to kind of moderate. I think this would be the first time this century since 2000 that you've had two 20+% positive years back to back. So what we would expect, we'd expect more moderate returns. We would expect everything around that to then be more competitive to public stocks, whether it be a lot of fixed income investment areas or whether it be these alternative areas. It's a pretty positive environment for hedge funds. There's a lot going on globally that is kind of asynchronous, with some central banks raising rates, some lowering the whole thing. There's a lot of kind of fluid activity that presents opportunities for a lot of hedge fund strategies. So we expect it to be a good year. This year is ending well. Yeah. The returns have been quite strong the second half of this year. On the M&A side, probably picks up. How much? It's hard to say, but I think there'll be some pickup. And then I think some of the areas that have lagged will kind of in a mean reversion fashion start to lead maybe. But one way or another, you've had an environment for public stock investors where for 2 years, the main thing going on in the market has been the so-called Magnificent Seven. Right. So 7 mega tech stocks from NVIDIA and Apple on down. That already appears to maybe be broadening out strength-wise, and I would expect that to, things like small caps, mid cap stocks that have lagged for a couple of years could see a better, year or a couple of years in front of us. International markets, most of the time, the U.S. market is strong enough that it really hasn't been necessary to go too far afield internationally. European returns have been weaker. China's been very weak for a couple of years now, but I think there's certain areas in Europe that are actually showing strength and could show returns the next couple of years that are competitive to the U.S. And then certain areas like Japan and maybe China if it perks up. So there may be more reason right now to consider adding to allocations, both small and mid caps in this country and then in some international areas.
What about this kind of cycle around venture capital? You've heard the term vintage really matters, right? And it appears that if you look at the macroeconomic headwinds of the last, 30 years or 35 years, it seems that venture capital kind of outperforms in these kind of recessionary macroeconomic headwind environments, particularly, the vintage of 22, 23. But then you paradoxically have this like stock market ripping with high interest rates. So maybe you could unpack that a little bit for us.
Well, if you pick a long-term period for the stock market, pick your period, 50, 100, whatever, 25 years, you're really looking at long-term returns of about 9 to 10% a year. So, venture capital is something with that being your backdrop. Venture capital is obviously something, given the risk parameters in the business and given the illiquidity of the asset class, you're certainly expecting greater than 20% returns. And most investors would say 30 plus. If we now kind of pivot into, at least temporarily, a more muted stock market environment, those returns become obviously even more attractive. And then you obviously have the current dynamic that we've not had in other cycles of something as large as AI and the investment boom that is driving. That's something everybody is trying to figure out, like day to day right now, how to be positioned correctly for that. But that's certainly going to be a big driver in the VC story as well.
Is it just a matter of investors seeking liquidity and returns and risk off that you think kind of drove the markets over the last couple of years into this unprecedented, or not unprecedented, but first time in a couple decades of 25% returns? Is it just investors kind of looking at the market and going, hey, there's pretty high rates here. I want to kind of go to quality, go to liquidity. And, it's a supply and demand thing. There's only so much stuff to buy on the stock market, and the Mag 7 and stuff like that. And so you just have this like flood of dollars into a smaller and smaller number of securities that are seen as risk off, safe bets, and therefore the stock market rips. And then you get to this moderate year, 25 might be one, 26 might be one. Now, kind of maybe a year from now, you're kind of looking at it like, looks like I only got 5% on my public equities this year. Maybe I need to go risk on a little bit. Is that kind of how this pendulum kind of swings around these asset classes?
No, I think it's a good question. You have to drill a little deeper on what's happened in the last couple of years, though. And, I mentioned small and mid caps. I would include the other 493 stocks in the S&P 500 below the Mag 7. Really, the performance has not been all that huge. It's been positive, but it's been, low double digits. And the valuations of those companies broadly are not at terribly stretched levels. They're a little elevated. It's certainly not a cheap market overall, but they're nowhere near what you're seeing for the Magnificent Seven valuations. But you called it a flight to quality. It's an interesting comment because we've not seen anything like this before, at least in my career, where companies reach obviously $3 trillion valuations so quickly. And then we bring up the comparisons to the dot-com era. I personally think this is significantly different than the dot-com era. I was running a fund at that time. That market was being driven by IPOs that aren't happening right now. The window, like you mentioned, has been fairly closed for a while. That market was also driven by companies that not only were coming public and were not profitable, but in a lot of cases didn't have any revenue. And so you and I have talked about wanting thresholds of annual revenue in investments, as downside protection. And I agree with that. Today, the Microsofts, Apples, NVIDIAs, they are extremely healthy companies. They have solid revenue growth, often double digits. They have flat to up profit margins, and they generally have fantastic balance sheets. So are they expensive? They are. But are they also kind of high quality companies that, like you said, kind of in a flight to quality just kind of created a self-fulfilling loop for the last 2 years where people said, I have to own these companies. I can't be heavily under allocated to these companies. If they're 28% of the S&P and I only have 5 or 10% of my investors' portfolios in it, I could really lose on a relative basis. So yes, There's definitely been a flight to that group.
Yeah, that's really interesting. So looking back over your career, what other lessons would you like to impart to the audience on alts that you've kind of accrued over time?
At the end of the day, you invest with people. So, lesson learned is to focus your investments. In this case, we're talking about external manager investments, obviously, to alts managers, whether it be hedge fund managers or private credit or private equity. Focus your investments with very consistent managers, GPs, meaning they have a very tight investment strategy and they've done it for he or she has done it for a reasonable period of time. They didn't pivot last year and decide they want to get into crypto after doing industrials or something like that. So their history in the strategy. Their history of risk management. You can go and look at tough periods in the past for their strategy and see how did they protect capital against public markets. And so these managers or these funds could be established and have been around a lot of years, or they could be very young. Maybe someone started this fund, a year ago after spinning out of a larger hedge fund or private equity firm, but you have good visibility or transparency into their past returns. You know how they did. And then you're able to really kind of drill down on the operational side of what they're doing now. How are they building this business? Are they building a business that is going to survive in terms of infrastructure investments, technology? Are they putting smart people in the seats around them? So, those are the things, kind of the people issues, sitting down across the table and getting a sense of the investor and what they are building, much more so than a lot of the other aspects that go into the decision process.
Yeah, I love that. So kind of a two-parter. If you could go back and send yourself like an email as you were getting started back at Payne Weber, what would that email say? It's like a time machine email account.
It would say, work very hard to make sure you're surrounded by smarter people than yourself. You only are going to be highly successful if you are learning every day or every week and you are open to learning. And so when you are around people of your seniority or greater, and you're asking, what would my young self be? It would be people of much more seniority. It doesn't matter for short term how
we're talking about knowledge and ability, not just like I'm older.
No, totally. They have experience. They've done it well. And if you have to be a real junior person for a while, so be it. But if it's at a really good shop, right? And also you're working with people that give you some visibility, give you some transparency into their investment process and how they're doing it, and are willing to mentor and teach you, it's invaluable. The advice I would give is be around smart people who will teach you the basics and teach you the fundamentals of investing, whatever asset class it is. Investments are investments. And understand the basics, because if you don't get the basics, as things start to progress, you're done. You're behind the eight ball. So you need to know the basics. You need to not be afraid to ask questions when, the senior person in the group uses a term you don't recognize. Say, explain that to me. I don't understand that. And let them tell you, and then you've got it once and you never need to ask again. But I really think that's what I would say to the self is just work hard to always make sure you're around smart people where you will learn.
I love that. Well, let's switch to rapid fire to wrap things up.
Oh, dear.
No, don't worry. It's going to be fun. What is your favorite finance book or resource?
That's tough. There's a lot. One of the themes maybe that we've already kind of danced around is important is understand who or what you're investing with very, very clearly, right? You've got 160, and I'm highly confident you've never, written a check to a strategy that you don't understand. And so I think that...
No, I have. Out of 160 companies, I've made some mistakes for sure.
Fine, but good work up front. So, along that theme, just invest in things and you understand. It's crazy, but when I was in college, there was a famous book by Peter Lynch, who was the top, investor.
One Up on Wall Street, was that the book?
One Up on Wall Street. Yeah. To boil it down, he said, invest in things and you understand. Invest in companies you can understand how they grow, how they fail. All those things, as opposed to a lot of esoteric things you don't really understand.
That's why I never invested in Web3 or crypto. I just didn't understand it.
Yep.
And I didn't understand why it needed to exist. And I'm sure it does, and I'm sure there's a place for it, but I just never really could understand why. And so I just never invested, and I probably dodged a lot of bullets.
I would probably agree. So I think that's one book. To be a little more current, I read a book called The Emotionally Intelligent Investor. It's actually by a current hedge fund manager named Robbie Maida, and his theory is kind of similar, which is understand what everyone else that's invested in whatever you're invested in. Let's pick a stock, right? Understand what everyone else that owns NVIDIA alongside you is thinking. Why'd they get in? When will they get out? What are they looking for? And be basically, as he says, empathetic and understand the dynamics that will dictate how that investment does. So I think there's a common theme to both, which is understand what you're investing in, and you're really off to a good start. Both of those books are really interesting on that topic.
Yeah, I've heard of the emotional one, but I haven't read it yet, so I'm going to check that one out. What's your best investment decision you've ever made?
I don't think I would probably drill down on a single one. When you've been around a long time, there's a lot of good and certainly some bad as well. Thinking about it more broadly, I would say kind of the best investment decisions tend to have common characteristics. They tend to have a fairly similar profile. And that profile would be often a megatrend that leads the investment to be profitable for many years. It just compounds. And it's the best performer in your portfolio for many, many years, as opposed to a rocket ship that you're in and out of in 6 months. I think there are some of those today in the energy transition space that will play out over the next couple of years. I think back earlier in my career, I think a lot of them also had a characteristic of being somewhat contrarian. So if something's already highly valued because everybody loves it, it's hard to make money. It's hard for that firm to outperform their earnings estimates or whatever. So you're starting with a very difficult bar. When you have a contrarian bent, it gives you much more room for upside. I remember investing in companies that the market didn't like at all, that were phenomenal companies going back to the 1990s and early 2000s. Blockbuster Video is one. Marvel Comics is another one. When they were both just thought to be, uninteresting companies without growth, and, good fundamental analysis, I think, showed you otherwise, that they had really room to grow for many years.
What's the worst investment decision you've ever made, and what did you learn?
I was afraid you're going to ask that. Again, I don't want to pick a single one, but I'll give the profile. I think it's where you don't do your work. I think it's where it's a story stock or story investment. And certainly in your world in VC, a lot of the story is out in the future. So that's part of what you have to deal with. But when you're in the public markets, I personally believe, don't want to focus a lot of your attention on story stocks, where it's trust me, this is going to happen in 5 years, and somebody else brought you the idea and it sounds great, and you take a flyer on it. You don't do enough of your own work. You don't understand exactly what you're investing in. In my experience, they tend to work out poorly.
Yeah. I've definitely been there where, it's a founder, they're pre-launch, pre-revenue, and
Yeah.
it's a story. And every time
Right.
I've done one of those, it's never worked out. It's like almost every time. Well, never is a strong word, but almost always. And so I'll tell founders, like, I don't really invest pre-launch, pre-revenue. You got to
Right.
show me what you can build, and you got to show me that people want to buy it.
You
Otherwise,
you you use
otherwise
the
it's just a
annualized
story.
you use the annualized revenue as kind of a margin of safety, right?
That's it. Yeah. You get 20 or 30,000 a monthly recurring revenue, 2 or 3 founders. You basically have, your default alive more or less, and you can pay the bills and figure out product market fit as you continue to iterate. You're not under this pressure of like, and other companies that I've seen, like, oh yeah, they got up and to the right metrics and usage or users or pilots or LOIs or design partners, like all that stuff is just like, it's just smoke. Hard and fast. I'm paying for this. I need to run my business with the software that you're selling me. That's kind of what I've learned to hone in on.
You and I invest in very different areas. You have a focus on VC, and I do some public markets and hedge fund and all that. But it's the same story, right? It's the same thing in terms of you and I both look at so many investment opportunities on a weekly or monthly basis that it's just easier to find reasons to not do something and to make yourself more and more selective than to keep falling in love with some story. So I think there's a lot of
I think if you just maintain diligence and I'm only going to invest in businesses, founders that have a great vision, all that stuff. That's like, yeah, of course you got to have that. But do you have a business? Otherwise, it's just a story. Exactly. I love that. Otherwise, it's just a story. What's one thing you always look for in a manager? Fund manager in this case.
Can I give you 3? One is integrity. Right? You have to check the person out, know their history, hear about them from people they worked with. Second is transparency, because again, you want to know what you're invested in after the investment. You want to see the results. You want to understand what they're doing. You want to have good dialogue with them in good and bad times. And then third would be passion. You want to be invested with managers who just have a consistent and ongoing passion for what they do, because if they love what they do, it increases their chances of succeeding, right? Whereas if they're on the backside of their career and they're starting to kind of lose it and all that to me is kind of a recipe for disaster. So, when a manager is excited to tell you about what they're doing, tell you about new investment they made, you've got to take it with a grain of salt and make your own decision on that investment. Yeah. But when they have that passion and they're telling you what they found and they think they're going to make you a lot of money in the next couple of years with that position in their portfolio, it's a good moment. They have the passion for their job.
I love that. Well, Terry, thanks so much for coming on. I feel like we ran out of time. There was so much that we didn't get to, but I really appreciate you spending the time with us.
Likewise. Appreciate you having me, Brian.